In 1637, a single tulip bulb cost more than a luxury house. In 2000, Pets.com burned through $300 million in just 268 days. In 2008, the entire global financial system nearly collapsed. What do these disasters have in common? And more importantly, are we about to repeat history in 2025? Welcome to Financial Mysteries. Today, we're connecting the dots between history's most catastrophic economic bubbles and the warning signs flashing red right now. By the end of this video, you'll understand the pattern that repeats itself every few decades and why recognizing it could protect your financial future. Let's travel back to the 17th century. Tulip mania. From 1634 to 1637 in the Netherlands, rare tulip bulbs became the ultimate status symbol. Prices skyrocketed. At the peak, a single bulb was traded for 10 times the annual salary of a skilled craftsman. People weren't just buying flowers. They were buying futures contracts on bulbs that hadn't even bloomed yet. Then, in February 1637, the music stopped. The market collapsed by 99% in a matter of weeks, bankrupting fortunes overnight. The lesson? When speculation becomes completely detached from any real value, disaster is inevitable. But tulips were just flowers. What happens when an entire nation's economy becomes the bubble? Let's jump to the early 1700s in Britain and the South Sea bubble. The government, drowning in debt, created the South Sea Company. They promised investors exclusive trading rights and enormous profits from South America. The public went wild. The stock price soared over 1,000% in just a few months, fueled by hype and wildly exaggerated claims. Even the brilliant Sir Isaac Newton got caught up in the frenzy, losing £20,000, a fortune worth millions today. He famously lamented, "I can calculate the motion of heavenly bodies, but not the madness of people." By September 1720, the bubble burst, leading to complete collapse and widespread economic devastation. Now, fast forward 280 years to a time when a new technology promised to change everything. The Internet. This was the dot-com bubble. From 1995 to 2000, the NASDAQ Composite Index surged by an incredible 582%. Investors poured billions into Internet startups, many of which had no revenue, no profits, and no viable business plan. The mantra was eyeballs over earnings. Companies like Pets.com and Webvan were valued in the billions, only to flame out spectacularly. Between March 2000 and October 2002, the NASDAQ crashed 78%, erasing $5 trillion in market value. The pattern was becoming clearer. A revolutionary new technology, fueled by easy money and a dangerously optimistic belief that this time is different. But the worst was yet to come. The global financial crisis of 2007-2008. The asset this time wasn't tulips or tech stocks. It was housing. The belief that housing prices never go down became gospel. Banks handed out subprime mortgages to borrowers who couldn't possibly afford them. These risky loans were then bundled into complex financial instruments called CDOs and sold to investors around the world, spreading the risk like a contagion. When homeowners started defaulting, the house of cards began to wobble. In September 2008, investment bank Lehman Brothers collapsed, freezing the entire global financial system. The result was the Great Recession, which wiped out an estimated $10 trillion in global wealth. Now here's where it gets uncomfortable, because the same warning signs are appearing today. Let's look at the metrics that have historically signaled a market top. The S&P 500's price-to-earnings ratio is currently sitting around 31, while its historical average is 16. That's nearly double. The CAPE ratio, a measure of long-term valuation, is at 39.8, far above its average of 17. And the Buffett indicator, which compares the stock market's value to GDP, is at a staggering 217%, when 100% is considered fairly valued. Some models are showing a recession probability as high as 93%, Add to this other concerns. In August 2025, the economy created only 22,000 new jobs, one of the weakest reports in years. We're facing the threat of stagflation, high inflation combined with weak economic growth. Consumer debt is at an all-time high, and corporate debt has now exceeded the levels we saw just before the 2008 crash. The uncomfortable truth is this: every metric that predicted past crashes is flashing red simultaneously. So what's the common thread? The pattern is always the same. It starts with irrational exuberance that, this time, is different mentality. This is fueled by easy credit, as borrowed money pours into speculative assets. Everyone starts to dismiss fundamentals. Valuations don't seem to matter until suddenly they're the only thing that does. Herd mentality takes over as FOMO, the fear of missing out, drives people to buy at the absolute worst time. And throughout it all, regulatory blindness often allows the bubble to inflate to dangerous levels. The key insight is this: the bubble doesn't burst because of new information. It bursts because the fundamentals were never there to begin with. History doesn't repeat, but it rhymes. Understanding these patterns doesn't mean you can time the market perfectly, but it does mean you can prepare. Diversify your investments, reduce your debt, maintain an emergency fund, and never, ever invest money you can't afford to lose. If this video opened your eyes to the patterns shaping our financial future, subscribe to Financial Mysteries, where we uncover the lessons history keeps trying to teach us. What warning sign concerns you the most? Drop it in the comments below. Thanks for watching.